On the other exchange, I think they closed it at 52 or something. But the 50 level from the actual trading floor that day was, according to them, a matter of minutes. So the point being well taken is this. It did not stay at 50 for very long. Now, did it hit 50? Yes. And that's taken place. And when these things happen, it's very normal that the down push is greater than the up push, meaning markets fall faster than they go up. So we saw, like a 5%, 6%, move down in the silver market. Gold got hammered fairly well also. But these are actually healthy for the market. So China is really the most, I think, swing factor in the silver market right now and India, both, for physical 1,000-ounce bars.
David Morgan, a longtime silver analyst and founder of the Morgan Report, recently explained the sharp volatility seen in the precious metals markets. He noted that silver briefly touched the $50 mark, but only for a matter of minutes before swiftly retreating. That's typical behavior, he said, as markets tend to fall faster than they rise, and such pullbacks are actually healthy for long-term stability. Both gold and silver experienced intense downward pressure, but these corrections are natural pauses in an ongoing bull trend. The real story, Morgan emphasized, lies in the physical markets, where China and India have emerged as dominant swing factors driving demand for 1,000-ounce bars. Their appetite continues to shape global supply dynamics in real time. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
And that's taken place. And when these things happen, it's very normal that the down push is greater than the upward push, meaning markets fall faster than they go up. So we saw, like a 5%, 6%, move down in the silver market. Gold got hammered fairly well also. But these are actually healthy for the market. And the reason is you don't want a market to go straight up, because if that happens, there isn't really any support on the way up. So what you really want to see is a stair step. So silver goes from 35 to 37, 38, trades in that range, 37 to 38 for 3 weeks. Then it moves up to 40. It bounces around 40 to 42 for a month. Then it bounces up to 45 and goes down to test the 38, level, whatever. So what you want to see is support. You want to see a lot of buying in ranges as it works its way up, as I said, as the stairs. If it goes up, 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 there's no support. And it's like throwing a tennis ball in the air, David, where, you throw a tennis ball as hard as you can, and it just keeps going up until it reaches that point of zero momentum, and it actually stops midair for 2 milliseconds, and then gravity takes over and starts coming down. And that's a good metaphor for a parabolic move. If you look at the structure of the market, it actually, in silver, has not come down to the level where a lot of these shorts have been able to cover their position, because the open interest has stayed about the same. And that's key to note, because what that means is the guys that are on what I would say the wrong side of this market, that expect the price to keep coming down, may not get their wish and are not able to exit their shorts and are stuck, especially if the market continues higher. Not saying it will, but if it does, then they got to suck. So do I take a paper loss or don't I? Or can I force the market down? So we are in a really strong bull bear scenario where I would say the shorts that have always anticipated their ability to move this market around are having a heck of a lot more difficulty doing so. And that same statement on the other exchange, I think they closed it at 52 or something. But the 50 level from the actual trading floor that day was, according to them, a matter of minutes. And according to some of the old heads that are as old as I am, they said it was maybe an hour. So the point being well taken is this. It did not stay at 50 for very long. Now, did it hit 50? Yes. And going to what you said and just reframing it, David, and you're spot on, that is a psychological level that really holds merit. And I think it still does, because we have seen it go past 50 and stayed there for a few days. We got prints. It closed. Traded all day above, traded another all day above, traded another all day above. But it hasn't been a month, it's been days. And now we're below 50. So I really think it's a battle line for, let's say, the commercial interests, the bullion banks, to kind of persuade the psychology. As you said, that word, it's a good word. Hey, 50's it for silver. It can't do more than. See, you're not doing the right thing buying silver. It's China, and it is, the technological revolution. Plus, I think it's let's say, maybe sovereign wealth funds, maybe it's deep pockets that understand the silver market that I think are taking silver for various. And the thing that's very interesting about the silver market is physical silver is needed in the London market to clear the market. How much? It's been reported or purportedly 150 million ounces, which last time I checked, the COMEX only had about 170 million in the registered category, which is readily available to ship to London or wherever. I personally not sure it's going to take that much, but it'll take some physical to clear the market. But the ace in the hole, the outlier, David, is this section or Article 232, which puts silver in the critical metal category. Now, it's been put on the list to be determined to be a critical mineral, but that vote has not taken place yet. And it's probably going to be delayed because of the quote unquote close down of the government. The government comes back and says silver is a critical mineral. Then I would submit that there's a highly strong probability that the need for silver will go to the government as a strategic or critical mineral, and they would have to buy it in the open market. And the strategic stockpile in 1985 was 140 million ounce round number. So if they all of a sudden decide the U.S. government said we need it as a critical mineral, let's stockpile it. And they said, how much do we need? We need 100 million ounces. At this point in time, that would put further stress. And you also have the Saudis that bought about 1 million shares of the SLV race recently, which just puts them in the position of an authorized participant, which means they can actually use the SLV as a source to get physical metal, because if you meet the threshold, you can change that paper shares into physical metal. So that's putting further stress. And as I said earlier, India has a ETF that's backed by physical, and they're waiting to get more so they can issue more shares. So there's stress in the commercial side of the market that I've never seen. And that is the real silver market. Not that retail isn't important, but it's sort of it's the tail of the dog, basically. The dog is the real physical silver market backed up or played around by derivatives.
David Morgan discussed the recent turbulence in the silver market, explaining that quick sell-offs, such as the brief dip below $50, are part of the natural market's behavior. Markets, he said, tend to fall faster than they rise, and healthy corrections help build long-term support, creating the stair-step pattern that sustains fundamental bull markets. What's more, he noted that short sellers appear trapped, unable to cover positions as open interest remains high. Beneath the surface, physical demand from China, India, and even sovereign wealth funds is tightening supply. At the same time, U.S. policy discussions about designating silver as a critical mineral could add even more pressure. The result? A market under real structural stress, unlike anything seen in decades. Let's get into the interview.
If you look at what happened in 1980, you can go back to the Hunt brothers, and there's a book called Silver Bulls by Paul Sarnoff. It explains almost every day leading up to the peak. It's a great read if you're a silver fanatic. In 2011, that was basically based upon, it's always paper trading. The silver market is a derivatives market, but the backup on it is 1,000-ounce commercial bars. It was very extended. I called that top, by the way. And that was mostly retail. Of course, institutions are always on the other side. But this time it is different because it's the silver market, hard asset, physical commercial bars, 1,000-ounce bars, that are difficult to get in the quantity required to clear the market, which means the refiners basically are not taking any junk silver, sterling silver, silver jewelry to smelt down into 999 fine because it takes too much time and energy. Whereas they will take a 100-ounce 999 fine bar or a kilo bar that's 999.5, because all I have to do is throw that in a pot, melt it down, and pour it into a 1,000-ounce bar. So these refiners are backed up with metal that they need to refine, and they're pouring it out into 1,000-ounce bars basically as quickly as possible. There's not really that much refining capacity that takes place in the United States anymore, but there's some. Most of the refining takes place in China, and China imports, the lion's share of the silver, and they export back out after being refined to the people that, moved it in, like a mining. Most people don't know that smelters get paid in metal. So if I ship in 10 million ounces of metal and my contract is, 10% goes to them, or unless there's what's called nasties in it, the refining process is more difficult, they might get a higher amount back. So China is really the most, I think, swing factor in silver market right now and India both for physical 1,000-ounce bars. And recently, the Chinese have come into the market on the retail side, which really hasn't been the case for quite some time. It's been gold, and even India has kind of switched to gold as they become more prosperous. But now India is doing a lot more solar, and they have silver ETFs, which demand physical silver to back up the ETFs, and kind of waiting for that silver to come in to India so they can increase the share quantity, the amount of shares that they can issue because they have the silver to back it up. So this is something that I would say I've always more or less thought or predicted that there would be a day, someday, that the commercial bar market, the physical, what's really the silver market, the derivative market that's based on commercial bar, is what takes hold. And that's happened. The other times we've had those runs, it's been more or less retail buying, retail products, 100-ounce bars, bagged silver rounds, government issued coins, and that's part of the equation. But the real silver market's determined around commercial bars, and that's where we have a problem. We have different prices in India than we have in China, different prices in China than we have at the LBMA, different prices at the LBMA that we have on the COMEX. So now who's who in the zoo? If you don't know what the real price is, you can't really even hedge. And if you can't hedge, you're going to put up a sign on your website saying, we're out of silver, we're closed for business. They're probably not out of silver, closed for business. But if you can't hedge, you have got a problem. If you are a big coin dealer, if you're a manufacturer of silver shot or silver wire or silver fluids or silver mesh or whatever. So it's kind of messed up the market in a way, because if you don't know what the real price is, in the future, or can't hedge what you have. The bigger story is that gold is absolutely a monetary metal. And that's really what it, period. So silver is both an industrial and a monetary metal. And so it's got a correlation with gold. I haven't checked it recently. Going back about 5 years, it was proven to be about 85% correlate, which is a very high correlation. But it also has at times when it acts more as an industrial metal like copper. So silver is sort of a dual personality. Some of the time it tracks gold stronger because its monetary demand is higher over, let's say, industrial, or at least at the margin, it's monetary. And at other times, the monetary demand is not very strong, like it has been not very strong in the last couple of years up until recently. I'm not talking the last couple of months, but the last few years. It's been more of an industrial story than a monetary. Copper is a pure industrial story. So silver kind of oscillates between I'm an industrial metal or needed industrially or I'm needed monetarily. So that's actually why you get that tracking.
David Morgan concluded by highlighting that the current silver bull market is fundamentally different from past cycles. Unlike the speculative surges of 1980 and 2011, today's strength is rooted in the physical market, driven by demand for 1,000-ounce bars and industrial use, not just retail speculation. Refiners are operating at full capacity. China dominates global refining and imports, and India's push into solar and silver-backed ETFs is further tightening supply. Meanwhile, price discrepancies across global exchanges reveal profound structural distortions, a sign of real physical stress, not just paper volatility. Silver's dual role as both a monetary and industrial metal gives it a unique advantage in uncertain times, especially as physical shortages deepen. If you value clear, data-driven insights like this, don't forget to like, share, subscribe, and drop your thoughts in the comments below.